There are several advantages, or pros, to using earnings per share as a tool in stock market analysis. One advantage is its simplicity. The idea of dividing profits among shares is straightforward and can be easily explained even to those who are not financial experts. This simplicity allows investors to quickly grasp how much profit comes from each share of a company, making it a convenient starting point when comparing different companies. Another benefit is that earnings per share is widely reported by companies, making it readily accessible. Because the metric is standardized, it enables investors to compare companies even if they differ greatly in size and structure. Additionally, this indicator is useful in tracking a company's profitability over time. By comparing earnings per share from period to period, an investor can see if a company's profit is growing, remaining stable, or declining. This continuous tracking offers insights into the business's operational effectiveness and management's ability to generate profits. Moreover, when earnings per share is used alongside other financial measures, it helps provide a more holistic picture of the financial health of a business, ensuring that decisions are informed by multiple perspectives. At the same time, there are situations when relying on earnings per share might not be the most appropriate approach, and it is beneficial to understand when not to use this measure in isolation. Earnings per share may not be suitable as a standalone metric when a company's capital structure is highly complex or undergoing rapid change. Companies that frequently issue new shares or engage in extensive buyback programs can see dramatic fluctuations in earnings per share that do not necessarily reflect the underlying business performance. For instance, a sudden increase in earnings per share might result from a reduction in the share count rather than an improvement in net income. In such cases, the earnings per share figure might be misleading if not analyzed in conjunction with other metrics. Similarly, for companies and industries where earnings are volatile due to external factors, such as cyclical industries or startups that have not yet achieved profitability, earnings per share might not be the best measure to rely on. In these circumstances, dramatic swings in net income can lead to equally dramatic fluctuations in earnings per share that do not accurately reflect the long-term potential of the business. Also, companies with significant amounts of convertible debt or options may report a basic earnings per share that appears robust but fails to incorporate the potential dilution, making the diluted earnings per share a more realistic measure. In summary, when the capital structure is unusual, when the business is highly cyclical, or when one-time events skew the net income, it is wise not to depend solely on earnings per share and instead look at a broader range of financial indicators. Watch our other videos for more information on earnings per share.